Hello, everyone, and welcome to Nettle, the best platform around for distance learning in business, finance, economics, and much, much more. My name is Sava, and what on earth has been going on the financial markets for the past couple of days? Today, we're going to investigate it together, figure out how short squeezes have pushed stock prices of some pretty obscure companies orders of magnitude upwards, how the Reddit community has perhaps outsmarted the Wall Street, and what strategies and stock picking techniques does the infamous wallstreetbets subreddit use to find their targets. We would also discuss what this whole situation means for us as finance and investment enthusiasts as a whole, and what can we potentially learn and implement to our own investment and trading strategies from this episode. Let's roll. In the past couple of days, a set of seemingly unrelated companies has attracted substantial media attention and generated abnormal upward market volatility, with some of the stocks showing double-digit or even triple-digit returns over the course of mere days or even hours. What does Blackberry, Naked Brand, Ligon Pharmaceuticals have all in common, except for maybe being quite distressed companies that you would never see recommended as good investments before the day before yesterday? Well, it all began with GameStop, so it's quite fitting that we start our analysis with it as well. GameStop is a brick and mortar, so premise-based and not online-based, gaming retailer that has been quite prominent in the 2000s, but everyone pretty much agrees that its best days are past it. Even before the pandemic and the crisis that followed since, the financials of GameStop were not looking good, and no one would recommend it as a good investment from a fundamental analysis perspective. No one would expect its share price to increase massively due to some fundamental consideration, due to some strong financials or strong signs in the books. And this belief that GameStop is surely going down, this bearish forecast, was quite universal in the finance practitioner community, among stock analysts, hedge fund managers, investment advisors, and the like. And it can be evidenced by a number of clear signs. First of all, quite high short interest in the shares of GameStop. Short interest reflects the number of short positions that are opened for the stocks of a particular underlying company at a particular point in time. Short selling is generally a good way to capitalize on your bearish forecast. You borrow a stock, sell it at the current market price, and wait until it falls to your fair value, to the price you expect would be about right for such a company. And then, when the price falls to that target, you buy the stock back from the market at a lower price you have sold it for, return the borrowed share to whomever you have borrowed it from, and generate some nice profit for yourself and for your fund. Sounds good, right? What on earth could go wrong? Well, a bunch of things. We can see, even from the short interest figures, that the consensus in the investment practitioners industry regarding GameStop has been overwhelming, even irrational, echo chamber levels of herding. The short interest as a proportion of outstanding shares, so total shares in circulation for this company, has been very high, almost 90% even at the end of August 2020, and most notably, mid-September, it exceeded 100%. There were more short positions open for GameStop than there were shares in circulation. Surely there's something wrong here, but this situation continued until very recently, with short interest as a percentage of outstanding shares fluctuating above 1 or around 1 until 15th of January 2021. Well, we pretty much all know what happened next, isn't it? Also, this vision can be supported by a striking consensus and strikingly bearish attitude of pretty much all stock analysts, even as recently as November end 2020. The market price at November end 2020 was $6.50, nothing to shine at, but massively lower than over $300 it's currently trading at. But I'm not exaggerating, all stock analysts who were following GameStop were considering $16.5 per share overvalued. Even the most optimistic analyst considered that it would be fair for the share price to fall to $13, and on average, analysts were believing that the share price would halve, and all the more so. So this consensus was something that the Reddit community wanted to exploit, and they could exploit it by leveraging the regulatory framework around short selling and the regulations in place in both the exchanges and the funds themselves. So to understand what was going on with the short squeeze strategy and how the share price is so high now, we need to understand margining. Margining is a common procedure in short selling and in derivatives trading as well that is designed to protect the exchange and the counterparties from counterparty credit risk, so you defaulting on your obligations either honestly or strategically, not willing to fulfill obligations that are unprofitable for you. And the general procedure is that when you open a short position on a particular stock, the exchange requires you to deposit the initial margin, which most commonly corresponds to 150% of the initial deal value. So you have to deposit all proceeds from your short sell, as well as some additional cushion to guarantee that even if the share price increases and you make some losses, you would not be incentivized to defaulting and not honoring your initial contractual obligation. And let's simulate a scenario where you followed the analysts at the end of November 2020. After all, the price was massively higher than even the most optimistic valuations, and see where it would take you today. If you have shorted the stock on the 30th of November 2020, you would have sold it at $16.56 per share. You would be then required to deposit almost $25,000 as your current margin, which is 150% of the value of a short selling deal worth 1,000 shares. And then this margin would be marked to market, reflecting your daily incremental profit and loss for the trade. And the profit and loss is calculated based on the daily price changes of your stock. If the share price drops, it means that you are winning based on your short selling trade. You can buy it back at a lower price and make yourself a nice profit. And if the share price increases, it means that the short selling trade is unprofitable. And here, daily and cumulative changes in stock price are calculated and converted into profit and loss. So here, daily incremental profit and loss for the whole trade worth 1,000 shares is being added to the value of the current margin. And this current margin reflects whether you are winning or losing money on your trade. And if this current margin is decreasing and decreasing below the initial value of the deal, and that reflects this margin call threshold of 100%, then the exchange becomes concerned, and rightfully so, that you might be tempted not to honor your contractual obligation and default strategically on the trade. So what exchange does, and what exchange generally do when they encounter such a scenario, is that they politely request you to top up your margin account and put basically some money to where your mouth is as collateral to guarantee that you would not just run away from the trade. And that protects the exchange and the exchange's reputation, it protects your counterparties, and it allows trust to emerge within the exchange, standard procedure. So what was going on with the current margin dynamics and with potential margin calls throughout the period? Well, no margin calls were observable throughout December 2020 and the start of January. The current margin was fluctuating around $22,000 for this particular trade. Again, we simulated it based on the assumption that you short sell it on 30th of November. If you've done so even before that, the situation would be quite a bit worse, but still. But it all changed mid-January when the Reddit community of Wall Street Bets started figuring out that there's something fishy going on there. What they figured out is that as the GameStop stock was so overshorted, there would be a lot of hedge fund managers, a lot of hedge funds, a lot of investment advisory firms that would have short positions open on GameStop. So it would mean that if a lot of retail traders long the stock, so simply buy stocks from the market. And given the fact that GameStop is not a massive multi-billion-dollar company, it would be considered a mid-cap or a small cap, depending on your definition. A coordinated community of retail investors could influence the price, theoretically, quite to great extent. And that's what they did. And why did they do it? What did they want to accomplish? Well, this is the essence of a short squeeze. When the price is pumped up by retail investors, and that's what's most notable, on the 13th of January 2021, when the story started unraveling, there has been a first margin call triggered in our hypothetical short position. It would mean that the exchange would approach the fund or the fund manager, the trader, who initiated the trade, and ask them to put $15,000 additionally into their current margin account, reflecting the losses that have been accumulating on the short selling trade. And here is where the trader would already have been in a lot of trouble with their superiors, with their line managers. Because, first of all, even within funds, there are regulations in place that require generally to get rid of selling positions, to put stop losses, and to prevent the fund from losing massive amounts on individual exposures. So perhaps this trade would have been cancelled and the short sell would be unwound, so the stock would be bought back by the fund and they would have just accepted the loss on this trade being unsuccessful. But even if they didn't, even if they wanted to continue with the trade, they would have to dedicate cash. They needed to pull liquid cash out of their operations and deposit it within the exchange, which is not something funds do lightly. But everything exacerbated the next day when the second margin call was triggered, with share prices increasing further. And this increase can be attributed both to the increase in activity of the Reddit community members, but also to the fact that some of the funds chickened at that stage and decided to unwind their trades and buy the stocks back. Because overall, ultimately, to close your short selling position, you need to buy the stock back at the market and return it to whomever you borrowed it from. It means that as funds and institutional investors at large concede on their short positions at GameStop, they fulfill this prophecy initiated by Reddit users and propel the stock price even higher. And that's how investors who initiate this pump scheme can profit themselves. If they short squeeze, if they trigger this massive unwinding of short positions, they cause these short sellers who were banking on the share price to go down at first to be their own demise, to propel the price further and generating profit for them, because they have long positions in GameStop. They benefit from share price appreciating. And that was caused this self-fulfilling prophecy cycle to unravel later on. We see that it was quite silent for the next 4 trading days, with funds figuring out what to do, whether they should get out of the positions, whether they should continue with them. But next, the next push that increased the price to $65 per share triggered a new wave of margin calls. And there has been a margin call in this imaginary scenario for every single day since. And increasing pressure of Reddit members, the retail investors who were long in GameStop, the additional upward pressure on the price that was made by short sellers who unwound their shorts and bought the share back and cancelled their trades, it all contributed to this skyrocketing of the price, to this explosive movement of the share price. So, does it mean that GameStop is a good investment right now? Not really. If we look at how the short interest behaves throughout, we can see that it reduced on the 15th of January. And given the fact that short interest is reported bi-weekly, we can imagine that right now, given how many funds have certainly unwound their trades, this is much lower now. So there is perhaps not much residual potential in this trade, and buying this stock for this high of a price is not a good idea from any long-term analysis metric. So perhaps GameStop is already not a low-hanging fruit. It's already a fruit someone has picked. It's a dollar bill on the sidewalk someone has picked up before you, unfortunately. But what happened besides GameStop? There were more companies in our list, and we're going to investigate 3 other ones. And the second most notable case is AMC Entertainment, a company that owns a bunch of cinemas. It's the largest cinema chain in the world by some metrics, that have experienced a similar issue with the current pandemic, the lockdowns, people not going to cinemas anymore, and that reflected again in quite high, not as remarkably high as GameStop, but still noticeable short interest in its shares, quite bearish forecasts, again, all forecasts, even the most optimistic ones, well below the market price November end. And also what is important to note here is the days to cover ratio. That is quite important in terms of risk management for the short squeeze trade from the perspective of retail investors from Reddit. We can see that for GameStop and for AMC Entertainment, the days to cover is quite notably above 1, and for GameStop it was quite high initially. Days to cover basically is a ratio between the short interest in a number of shares and the typical or current volume that is being traded at the market. And it is called days to cover as it represents how many days on average would it take short sellers to close their positions. And obviously, if all short sellers close their positions, there's no longer any benefit to reap from a short squeeze strategy. So it's quite important to understand it for market timing. When to time your pump, when to time your long positions on stocks, and when to exit the positions as short selling is liquidated. And we can see that for AMC Entertainment, this days to cover ratio was quite a bit lower than for GameStop throughout. However, if you consider current volumes, then at some point in time in September and also in December, it was exceeding 3 or 2 days, meaning that it was a decent bet that short sellers would not be able to liquidate their positions quickly, and you would have some time to make money out of a short squeeze. While for GameStop, this has been quite notably over 10 days high at the heyday of this bull run on GameStop shares. So it can be seen here that GameStop is a much clearer case than AMC. And AMC was chosen as the second best solution, and that's why it only gained prominence after the GameStop strategy was kind of ripped of its benefits. But still, we can consider that what is common among AMC and GameStop. We can look at ownership structure across various ownership types and see that what is striking and quite notable to the eye here is that for both GameStop and AMC, quite substantial portions of companies' shareholdings are allocated to investment advisors and hedge fund managers, which is more prominent for GameStop. Hedge funds own more than 10% and around 5% for AMC, but nevertheless, those are sizable chunks. And it means that such institutional ownership, corresponding with substantial short positions in the shares, would mean that institutional investors would first of all be coordinated in their short selling, and thus you could exploit this herding echo chamber behavior, and also that there would be internal regulations in place in these hedge funds and investment management firms that would sway them to close their short selling positions and basically chicken out, fulfilling the short squeeze and generating some good profits for the Redditors. The other 2 companies are, again, less clear of cases, and they emerged further on into the story, and those are Blackberry and Nokia. And Blackberry and Nokia, again, Blackberry is characterized by similar proportions of institutional ownership and similar, albeit not as pronounced, pessimism in terms of analyst valuations, while in case of Nokia, it's not even that prominent, with the market price being roughly on par with analyst valuations. But what is interesting for Blackberry and Nokia, and even if we look at days to cover ratios or short interest proportions of outstanding shares for Blackberry and Nokia, they are not at all matching the cases of GameStop and even AMC. But what Blackberry and Nokia short squeezes reveal is the sentimental nature of the Reddit trading strategy to some extent. Blackberry and Nokia, just as GameStop and AMC, are very 2000s. I can still remember as a kid in early 2000s getting my first mobile phone, it being a Nokia, how excited I was playing Snake and all of that, and how it reminds me of childhood and the golden days. And BlackBerry was the first smartphone that was considered cool, and it had buttons, and you could sign your emails and send your emails from your phone, and it was sent from my BlackBerry, and it was so cool back in the day. GameStop in 2000s, going to buy your favorite game, your CD or DVD from your local store. AMC, going out for the weekend for a movie with your friends. This corresponds to nostalgia and some sentimental value the Reddit community has in investing in these stocks in particular. And it is not really the sole motivation of those short squeezes. These short squeezes represent that those investors know how the market works, they know the institutional framework, they know how institutional investors are restrained and how to game on it. But they implement a little bit of a sentimental touch to their investment. And that is quite typical of many asset classes and many investment strategies in the 21st century. Consider ESG investing, environmental, social, and governance screening criteria, green funds, socially responsible investment, and those strategies that took off. They took off because investors and retail investors generally wanted to make money while thinking themselves as virtuous, and that's nothing to be ashamed of. Cryptocurrencies have taken off from small, engaged, enthusiast communities as a way to save and multiply your savings, but also by contributing something new and exciting to the world by developing new digital money. And these waves of similar sentiment can also be tracked in the strategies and actions of the Wall Street Bets community members. But what does it mean for us? Can we predict what the next target will be? Can we use the logic that they implemented to guide our own investment decisions? Well, perhaps. Here I've got a sample of all US companies who have got data on their short interest, on their ownership structure, and on their analyst valuations. And we can see which companies of those resemble our initial heroes the best. Namely, which of these companies have high short interest as a percentage of shares outstanding, relatively high days to cover to guarantee decent market timing for your short squeeze strategy, high institutional ownership, mostly corresponding to investment advisors and hedge funds, perhaps even more importantly hedge funds, as those are the main actors in short selling activities generally, and also that are generally being undervalued by analysts. So if we narrow our search from almost 3,600 companies that we've got here to only those that have more than 10% of their shares outstanding as short interest, that have a days to cover ratio of greater than 3 to give us some timing to exit our short squeeze long positions, and that are owned in their majority by investment advisors. Over here, let's input greater than 55% for investment advisors and greater than 4% for hedge funds, reflecting the figures we have seen for the 4 companies we investigated before. We'll get a selection of companies that is quite insightful. Here, as one of our first entries, we can see Bed Bath & Beyond, which is one of the most recent targets of the Wall Street Bets Reddit community. We see that we have stumbled upon something here, how they really detect their targets. As Bed Bath & Beyond is quite overwhelmingly shorted, short interest, over 60% of the shares outstanding, quite undervalued by analysts. As we can see here, the analyst consensus price, the average consensus price of 23, is below the market price at 36.87, and even the highest valuation is below the market valuation. It being quite distressed in terms of its return on assets, -3%, and it being overwhelmingly owned by those two classes of investors, investment advisors and hedge funds, respectively. And we can also here see some companies that are suspected overwhelmingly to be next targets. For example, Macerich, which is a real estate holding company that has also suffered quite tremendously during the current crisis, with having a negative return on assets again, having quite high figures on institutional ownership, being slightly undervalued by analysts, and showing quite high up on short interest and days to cover. We can also see a company that's very similar to AMC in its business model and recent performance, which is Cinemark Holdings. Short interest and days to cover are almost identical to those of AMC, with institutional ownership also scoring quite high and analysts also being quite pessimistic about it. And in this selection of companies, we can see a lot of corporate stories, stories of perseverance, stories of struggling quite a bit financially under the current crisis and the current policies, as many of us are, and stories of investment practitioners being quite biased, perhaps heavily on one side, and the retail investor community, such as the wallstreetbets, for example, being swayed in the other direction, trying to obviously pump up the price above the fundamental valuations and make the profit for themselves. Don't be delusioned by the fact that they are some kind of Robin Hoods or selfish activists. No, they want to make profit for themselves, but that's what the beauty of the market is. You contribute to the price discovery, you eliminate behavioral biases that are inherent in humans on the aggregate price, and restoring the equilibrium gives you profit. Obviously, these stories are perhaps swaying it too much in the opposite direction, but the markets are volatile, the markets are chaotic, but chaos in terms of the markets is what produces the equilibrium. So we should be quite optimistic, I guess, about what's going on the markets right now, despite the fact that it's quite alarming volatility, and despite the fact that you should most likely not invest in the companies that are under the radar now, the GameStops and AMCs of the world. And that's all there is for the case study of short squeezes on the financial markets recently. Please leave a like on this video if you found it helpful. In the comments below, I may see any further suggestions on videos for business, economics or finance you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much and stay tuned.